Senior economics reporter Steve Leisman joins us now with the latest results of the CNBC Fed Survey. Hey, Steve.
Good morning, Joe. Wall Street increasingly embracing the idea that the Fed is going to hike and hold at a restrictive rate rather than the old idea, which was that it would stop short and then cut quickly. The September CNBC Fed Survey finding that 75 basis points is the call for this week. All of our 35 respondents, except for two, who put it at 100, but mostly saying 75. Then that peak rate, the terminal rate, 4.26 now. And that is 40 basis points higher than the July survey. That peak rate is hit in March of 2023. Then the important question we asked this time, how long will the Fed hold there? 11 months is the number, with some saying as few as 3, some saying as many as 24. The recession risk now 52%, little changed in the next 12 months, by the way, little change from the prior survey. John Riding writes, the Fed has finally realized the seriousness of the inflation problem and has pivoted to messaging a positive real policy rate for an extended period of time. That's the important part there. So there's the trajectory. 240 right now, 238, call it. We reach near 4% by the end of this year, go up to that peak rate in March. And then you can see that there is some cuts built in. That's the result of some thinking the Fed turns tail quickly. But the average, again, thinking the Fed stays there and holds, with cuts coming perhaps into 2024. Rates stay high because the 35 respondents think that it takes a long time for the Fed to bring down inflation to its 2% target. We're 8.3 now. We go to 6.8 on the CPI by the end of the year, 3.6 by the end of 2023. It isn't until 2024. Just 60% believe the Fed hits the 2% target. By the way, more than 80% of respondents did not change their inflation forecast over the next 2 years because of the Inflation Reduction Act. Along with the recession risk comes an expected rise in unemployment. Take a look here, what's expected to happen. You're at 3.7 now. Go to 3.8. Not too much damage by the end of this year, but next year, 4.4. It's still an historically low rate, but you often don't see a 1 percentage point increase from the bottom outside of a recession. While these respondents have argued over the past several months that the Fed was way behind the curve in tightening policy, many also now are concerned about the opposite, that it would go too far or further than it needs to go. Joe?
All right, Steve, we don't have enough of these, I don't think. How often do we see this, Steve? It comes very quickly, doesn't it?
The survey you're saying?
No. I look forward to the survey, these 2-day meetings where they're always important. They've gotten more and more important.
Every 6 weeks. You know, Joe, I think a lot of people would like it for the Fed to be more in the background than it is right now. But I really think what's going on is there's a lot of uncertainty about the outlook. And even though the Fed has proven that it's flawed at predicting the future, it's probably the best you got, right? If you say, well, the Fed is wrong, then where do I go to figure out what's right? And if I look to the market, I look to a market that's influenced by the Fed. Some people say, follow the 2-year. Well, guess what? The 2-year is not immune to the guidance being given by the Fed right now. So it is also influenced right there. I think we need to get to a place where the Fed is a little bit on cruise control, and the idea that it's going to get up there and stay there for a while, I think, is being baked into the market. So businesses and investors might have the ability over some period of time to have a little predictability once we get up to where we're going.
Shepard Smith here. Thanks for watching CNBC on YouTube.